Still. Okay, there's still some people logging on, but I think we should get started. So I heard Sam did a really good job as my replacement last week, but somehow they still let me keep my job. So I appreciate it. And thanks to Sam for helping out last week. Today's speaker is Federico Esposito. We talk about trade policy uncertainty and stock returns. For those of you who are new, the house rules are, if you have a question, just unmute yourself and interrupt just like you would during a regular seminar. Marco will also be in the chat room and he can answer questions as we go if you'd rather submit your question through chat also. Okay. Otherwise, Federico, you have an hour.
All right, great. Thank you so much, Kim and George, for inviting me. So this paper is a quote with Marcello Bianconi, who is my colleague at Tufts, and Marco Sammo, who is a PhD student at Northwestern Kellogg. Okay, so the recent trade war between US and China has brought trade policy uncertainty to the forefront of the economic and policy debate. And there is a recent evidence that trade policy uncertainty has large effects on economic outcomes. So we have seen effects on employment, investment, sales, inventories, trade, and welfare. And so a natural question that arises given this evidence is, do investors require compensation for exposure to trade policy uncertainty? Or in other words, does trade policy uncertainty affect stock returns? And stock returns are clearly an important determinant for firms in investment decisions, for household wealth, and even for employment, as recently shown by the literature. So in this paper, we will try to answer this question. So whether investors require compensation for exposure to a TPU. And to do that, we will use a policy shock, which is the 1989 Tiananmen Square crackdown, which is a pretty known shock in the trade literature, given the Pearson Schott paper in 2016. So essentially, as many of you know, before 1990, China was granted, enjoying low tariff rates that were granted to WTO members, despite not being member of the WTO, that was called NTR status. But after the Tiananmen Square crackdown, the US Congress decided to start voting annually to revoke this NTR status to China. And if revoked, tariffs would have been reverted to much higher Smoot-Hawley tariffs that were set by the Smoot-Hawley Act in 1930. And so this renewal process generated uncertainty on the future tariffs applied on Chinese products that could then be used both as inputs in production for US firms, but also be imported as final consumption goods. And then China was finally granted permanent NTR in 2001 upon access to the WTO. Okay, so we follow Pearson Schott AER paper and quantify the exposure to trade policy uncertainty via the difference between the high Smoot-Hawley tariffs and the NTR rates. So we will call these throughout the presentation NTR gap. And the identification is that industries were heterogeneously exposed to TPU based on the tariffs, mostly based on the tariffs set in the 1930s. So we think that this is orthogonal to the stock returns in the period of analysis. So what do we show? Is we first show a stylized fact. So by means of a Diff-in-diff specification, we show that high gap industries' stock returns were significantly higher than low gap industries during the uncertainty period. And then we show that this effect, so this differential in the stock returns, was larger in the early years of the uncertainty decade. So in the years, the first few years of the 1990s. And when this congressional voting process was a more politically contentious. So this is somewhat consistent with the idea that whenever there was more, higher trade policy uncertainty, because voting was more contentious, there was a higher a differential in stock returns. Okay, but so this is a Diff-in-diff statement, because we are comparing the returns in the 90s versus the return before and after. And so to make our claim stronger, we argue that these differential returns earned by high gap firms were a risk premium. And in particular, we argue that investors needed to be compensated for exposure to trade policy uncertainty, in line with the seminal papers proposed by Pastore and Veronesi about the effect of policy uncertainty on stock returns. And in particular, we will provide 3 pieces of evidence to support this hypothesis. So first, we will follow state-of-the-art techniques in asset pricing and show you that a portfolio long in high gap industries and short in low gap industries earn a risk-adjusted excess return of 6% per year during the uncertainty period, so only between 1990 and 2001. And the same portfolio does not earn any additional return, neither in the 80s nor in the 2000s. So we only see this risk premium only in the 90s, when there was trade policy uncertainty. And then the second piece of evidence is that we see a large and significant drop in high gap firm stock prices relative to low gap firm stock prices at the announcement of a new policy. So what I mean by new policies and policy, I mean that when the US Congress decided to start voting to revoke or not China's NTR status, essentially, so whenever the trade policy uncertainty actually started, we see a big drop in stock prices for high gap firms relative to low gap firms. And this suggests an increase in the discount rate that investors were applying when evaluating stock prices. So this is also consistent with our risk premium story. And third, we also show that the realized volatility was higher for high gap industries throughout the entire uncertainty period. It was even larger around the key policy events. And the key policy events that we will consider are the yearly congressional voting days and the key policy announcement dates, like the day when China was granted a permanent NTR or the day China joined the WTO. And so we will use like an event study technique to look at the realized volatility few days before and few days after these key events. Okay, and then if I have time, I will also show you that industries less protected by trade policy were the ones that were more exposed to the policy uncertainty. And in particular, we will look at, I use a technique that in asset pricing is called double sorting portfolios. So we sort portfolios not only based on the NTR gap, but also based on other measures. For example, we'll sort them based on tariff rates, so NTR rates, or shipping costs. And so we will show you that industries that were already less protected by trade policies, in the sense of having lower NTR rates or lower shipping costs, they are the ones that were more exposed to trade policy uncertainty. So in a sense, this result sort of suggests that industries that were already exposed sort of by the first moment of globalization, they were also the ones that were more exposed by the second moment of globalization, which is, given by the uncertainties around trade policy. This kind of informal way of saying. And then lastly, if I have time, I'll show you.
Federico?
Yes.
Is there kind of a cross equation restriction here about how much the fall has to be initially to be consistent with the higher premium that was subsequently there? I mean, in other words, what if you thought it wasn't affecting the long-term value, but it had to jump down in order to have a higher return subsequently?
Well, I see. So, well, the way we're gonna do this is, so we'll look at the monthly returns of these portfolios, and we will split the portfolios using the initial level of protection, the NTR rates, and the initial level of the NTR gap. And then we will also use the initial level of shipping costs. So we will hold that constant and sort and look at the path, the average returns of these portfolios over time, over the period of 144 months.
Right, now I'm just talking about the first and second bullet point there seem to be reflecting the same thing in two different ways, which is nice, but it seems like there's some discipline there about the magnitudes.
So I think maybe your point is, if we think about a standard thing like Gordon growth, right? P equals D over R minus G, right? If R goes up, P has to go down, holding everything else fixed, right?
Right.
And you're saying is the increase that we can expect out of R on the day that it dropped, commensurate with the increase in R we saw over the next 10 years? That's your question, right?
Yeah.
Yeah. We have thought about that a lot, actually, and that's something we tried to do. But the issue is that it wasn't just R that moved. It was also D. It was also G. And because as the literature documented, there was a lot of real effects. And so this is kind of a classic problem in asset pricing, that identification is really hard. So we can say there's a 15% difference between those firms in the month around that, which is enormous, which suggests R went up a significant amount. But you really have to make some assumptions of what you thought G was and what you thought D was for that to be right. So we haven't done that, but we thought about it. It's a good point.
Yeah, but so, and we will also show you like some sort of suggested evidence that it was more the discount rate that went up, because we look at the dividend growth rates throughout the entire period, and that wasn't significantly different between high gap and low gap. So we sort of try to disentangle the two effects as well. But thanks, Mark. And then finally, we will show you some evidence that sort of suggest that alternative explanations that could be reasonable to explain our results seems to be not satisfying the data. So, for example, we will look at the effect of future cash flows on stock prices. So the idea here is, there is a recent paper by Greenland and co-authors where they show that the short-term response of stock prices after the PNTR announcements, he has a predictive power on future firm performance, and so that could in fact contaminate our results. So we will repeat the portfolio analysis by excluding these days, and I'll show you that the results are pretty much unchanged. So this sort of is suggested evidence that this Greenland effect doesn't really contaminate our long-run risk premium estimation. And then the second important alternative story is that high gap firms may have enjoyed an implicit protection from China due to uncertainty, and so they could have enjoyed a higher expected cash flows and therefore higher stock returns. So this is a reasonable concern, and in fact, I'll show you some evidence by means of, again, the double sorting technique in portfolios, that industries that had a higher, so a lower import share from China, so industries that were effectively more protected from China, they are not the ones that are earning the risk premium. And it's actually the opposite. Industries more exposed to China were the ones earning the risk premium. So this seems to reinforce our hypothesis. Okay, so the contribution to literature, well, there is, I mentioned the literature on trade policy uncertainty on economic outcomes. George also has a paper on this and the effect on inventories and trade. So clearly, well, we focus on essentially on the financial side of the economy, so on asset prices and risk premium. And then there is another literature, also recent, that uses stock market event studies to evaluate trade policies. And so what the difference between our paper and this paper is that we focus on the long run effect of trade policy, because we are estimating a risk premium instead of a short run. And but I mean, short run, like these papers, they typically look at the like few days response of stock prices after policy announcement. So we think that we are essentially complementary to this literature. And then lastly, we also contribute to a literature in finance that studies the impact of policy uncertainty on stock returns. And we believe we have a better identification here because we use quasi-exogenous variation in the NTR gaps, but also because we use an ex-ante sort of measure of uncertainty, because the NTR gap, they can be measured at any point in time, rather than an ex post measure, meaning, like typically the finance literature has always used, the realized volatility or option implied volatilities, and these are all ex post measures, and also are measures that require several assumptions, while the NTR gap are directly observable. Okay. Okay, so let's jump to the timeline of the policy shock. As many of you know already, in 1980, China was granted low tariffs that were reserved for WTO members, despite not being a member of WTO. And during the time, despite like being, like this still needed an official approval by the president, there was no uncertainty about it, in the sense that there was no political debate on this, but still it wasn't like a permanent NTR status. But then after the Tiananmen Square crackdown, US Congress started to vote annually to revoke the NTR status. And so this generated uncertainty. The uncertainty is, will tariffs be raised to a much higher smooth only rates? And so this lasted until 2001, when China was finally granted permanent NTR. So just to be technically, Clinton signed the law in October 2000. China joined the WTO in 2001. We will use both dates in our estimates, in our robustness. So, and since then, uncertainty was resolved. Okay. All right. So, as in Pilsen-Schott 2016, we quantified the exposure to TPU via the NTR gap, which is the difference between the smooth only tariff rates and sort of WTO NTR rates. And if you just do a regression of the NTR gap on non-NTR gap across industries, 90% of, so the R square is 0.9, meaning that 90% of the deviation of the NTR gaps across industries arises from variation in smooth only tariff rates, which were set in an interest, which is reasonably orthogonal to stock returns in our period of analysis, which will be 1980 to 2007. And so we will exploit a large cross-sectional variation in the NTR gap to estimate the causal, hopefully causal, effect of TPU on stock returns. And when I say large cross-sectional variation, I mean this picture, because here you can see that the NTR gap goes from 0 to 80%. So, this means that, the difference between, so here and 0.8 means that if in 1 year, China was revoked the NTR status, that particular industry would have faced an 80% increase in the tariff on Chinese products. And the average here is 27%. And here we are plotting the NTR gap at the beginning of the uncertainty in 1990. Okay, good. So the first realized fact is a Diff-in-diff specification, very, very similar to the Pilsen-Schott specification. Yes.
So when we think about these gaps, you're thinking about these gaps where the industry is producing, not where it's getting inputs from?
Yeah, exactly. So, exactly. So these gaps are, exactly. So are the industry in which the US industry is competing with, in a sense, is sort of the uncertainty that the US producer there is uncertainty on the level of future competition from China that firm is facing. Yes.
No, I just wanted to make sure, because we could have thought that it's going to affect the risk to your inputs as well, the cost of your inputs. And I don't know if
Yeah,
you're going to
so-
control for that later on.
Yeah, so at some point in the past, we had an extension where we were looking at that, and we were finding that as well. So we were finding that if you if you source inputs from China, and these inputs are subject to trade policy uncertainty, you also see an effect on stock returns.
Mhm.
Yeah, we do. But I will not show you this today, but makes total sense. Yeah.
And can you clarify like the level of aggregation that you guys are thinking about?
Yes, I'll tell you
Okay,
right now.
great.
Yes, yeah. So basically here, what is this? So here, RITY is the return of value-weighted industry portfolio I in months T and year Y for the years between 1980 and 2007. So the way we're going to do this is we take ordinary common shares for publicly listed US firms in CRISP and CompStat, and then we will match the SIC code in CompStat to the Pearson-Schott family of industries. So, you know, they don't technically use SIC 4-digit codes. They use something a little bit more aggregated, but you can think about these as 4-digit SIC industries. Okay, and the reason why we do that is that, you know, like the shock. So the actual NTR gap is measured at the product level because tariff, you know, are set at the 8-digit level. But you know, like the returns, you know, like so you only know the sector in which the firm from CompStat belongs to. So you don't know the products that. So in principle, you could like construct a firm level exposure measure, but you know, like now we are looking at the industry level regression, which is the same industry level that Pearson-Schott do. Okay, so basically each month we construct a value-weighted portfolio at this Pearson-Schott industry level, where the weights are essentially each firm lagged market capitalization. So this is just a value-weighted portfolio, super standard in finance. And here on the right-hand side, you have uncertainty is a dummy equal 1 if a month T is between 1990 and 2001. And gap is the NTR gap of industry I in the year, in the previous year. So here we are using the lagged NTR gap only because essentially the assumption is that every year investors, they assess the exposure to TPU of a given industry by looking at the NTR gap in the previous year. But this is without a loss of generality. So I'll show you some robustness where we fix the NTR gap to the NTR gap in 1990, and results are very similar. And then we have industry fixed effect, month fixed effect, and some time varying controls. So these controls are lagged financial valuation metrics, which are standard in finance. Yeah, so price to earnings ratio, price to book ratios, and so on. And then we also include all the policy controls that are included in Pearson-Schott. So change in Chinese import tariffs, NTR rates, quotas, and so on. Okay, so very briefly, some summary statistics. Well, here I'm dividing, for simplicity, firms into groups, low versus high gap. So yeah, so the high gap can be substantial for high gap firms. So you see here that typically these firms, they don't differ substantially in in their financial valuation metrics, which is a good sign. And we also do this for other variables, and they don't seem to differ substantially. So the high gap versus low gap. So that's a good thing. Okay, so here this is the first slice fact. So the first two columns use as the treatment group. The treatment period is always the same, 1990 to 2001. The control group here is the 80s, so from 1980 to 1989. And instead, in column 3 and 4, we are the control group is the 2000s, so after. And in 5 and 6, we are pooling the control groups together. And in the odd columns, we are running the unconditional regression, so without controls, except the NTR gap in 1990, because of course we have an interaction term, so you had to add that. And instead, in even columns, we add all controls and fixed effects. So you can see that throughout the specifications, we have a positive and significant coefficient of the interaction term, which means that high gap industries had relatively higher stock returns relatively to low gap industries during the uncertainty period relative to the control periods. So if you take this coefficient, so our preferred specification in column 6, and this coefficient implies an interquartile range of 4.2% per year. So this means that if you go from a less exposed industry at the 25th percentile of the NTR gap distribution to the 75th percentile, stock returns increase by 4.2% per year. Okay, so that's quite a sizable effect. And so one caveat here is that we are making a differential statement, right? So we are comparing the uncertainty period versus the control groups. Now, when we will turn to the portfolio analysis, and this is very important, we will only focus on the uncertainty period. So we will look at the returns of high gap versus low gap only in the uncertainty period. Okay. So here, very quickly, there is some robustness. Here, the coefficient doesn't statistically change if we control for, in column 1, for the betas of each industry with respect to the 5 FAM and French factors interacted with the uncertainty dummy, or if we double cluster standard errors at the month and industry level, if we use previous year weights, or we use an unweighted regression. And I forgot to mention that here the business regression is weighted by beginning of the period market capitalization, and standard errors are clustered at the industry level. I forgot to mention that. So yeah, so here the weighting scheme doesn't really do much. In column 5, we interact the controls with the uncertainty dummy. In column 6, we instrument the NTR gap with the smooth hole tariff rate, to further address the concern that maybe the NTR rate could be endogenous to the stock returns. And then in the last column, as I previously mentioned, we repeat the estimation with only using the NTR gap in 1990, so not using the time-varying NTR gap, and you see that the result is essentially the same. Okay. Okay, so this was the first slice fact. An addendum to this slice fact is this graph. So this graph looks at the dynamic effect of trade policy uncertainty. So essentially, in order for the effect to be really attributed to TPU, we should see that the returns of high gap industries were higher than the low gap only during the 90s. And in fact, to do that, we estimate 5-year rolling windows. So we estimate the baseline regression by using only 5 years, and using rolling windows, so adding 1 year after and removing 1 year before every time. So for example, the first point is estimates the coefficient using the first 5 years of the 80s. So you can see here that in the 80s, there was no significant difference between returns of high gap industries versus low gap industries. And I know that this is not a precisely estimated 0. It's a very imprecise, but at least is 0. But instead, if you look at the 90s, you see that the coefficient, the dynamic coefficient, is positive and statistically significant. So that's good. And and again, this is a not very formal statement, but you kind of see that these coefficients are not statistically different from each other. But the point estimate at least sort of suggests that the effect was a bit stronger in the first years of the 1990s and was going down over time. Okay, and so you kind of see the trend, right, from the 90s to the 2000s. But I know this is not a very formal statement. So I apologize for this. And then last, you can see that in the post period, you can see that actually the opposite happened. So the stock returns of high gap firms, rather than being essentially the same, they were lower than low gap firms. So we think that this is due to a cash flow effect that I mentioned before. So essentially, after PNTR, as Peter Schott and the literature has documented, high gap industries, they suffered a lot the competition from China. And so these may be reflected in lower stock returns. Okay, so this is not a concern for our main conclusions, because as I'll show you now, we will look at the portfolio analysis only in the uncertainty period. Okay, so we will look at, so the risky premium that we estimate is estimated only in the 90s. So we will not be contaminated by this cash flow effect. Any questions on this first part?
Yeah, just one question, kind of a more broad question, maybe. Is there a literature in finance that kind of finds effects from things that never happened but could have happened? I mean, because I thought that's kind of a neat thing about this, is nothing ever happened in terms of the risk, and yet you're kind of having a measure of what could have happened, and it's having an effect, which is sort of curious.
That's a very good point. In fact, that sort of goes back to the ex ante versus ex post uncertainty, right? Because to the best of my knowledge in finance, the literature uses ex post measures. So, you know, uncertainty is measured with volatility, which you observe, which is related to something that has happened. But as you're saying, this actually has never happened. So that's a good point. Yeah, so maybe we should make this point even stronger. The literature that I know and that we cite in the paper, does not look at this. So uncertainty that never materializes, but that's,
It's maybe a little bit like that literature about rare events that
I see.
Weitzman and Barrow had written about, but I don't know.
I was actually going to add to that, Federico. So in my paper with Jose, when we put in the disaster risk, and this is related to what Sam was just saying, even if the disaster doesn't happen, the way the fear of the disaster enters in the discount factor will have the same effect.
I see. Interesting. Okay.
There's also a sovereign default literature, which looks at things like the default premium for sovereign default swaps for defaults that never happened.
I see. Okay.
I was just to add one more. This is kind of like the classic peso problem, right? With the UIP. I think it shows up in a few different places.
Okay.
You
I'm writing down these notes.
Yeah.
Yes. Okay. So the peso problem, because there is risk that some shock could happen to the currency. Or
yeah, exactly. You know, you've got a fixed exchange rate, and you have this interest rate gap, and then it's just because the probability that they're going to devalue, right? Kind of the traditional peso problem.
I see. Interesting. Okay. Yeah. I'll make sure to make the connection in the paper. Thanks. Okay. Very good. So. Okay. So. Now we argue that this difference in high versus low gap returns was due to a risk premium for TPU. So to give you a little bit of conceptual framework, let's recall that in any asset pricing model, for example, you can find this in the Cochrane book or Duffy, the expected excess return of asset I is proportional to minus the covariance between the stochastic discount factor and the asset return. So what does it mean? So this means that if this covariance is negative, means that whenever there is a bad state of the world, so states in which the consumption is lower, so the marginal utility of consumption is higher, the stochastic discount factor is higher, but the return of that of asset I is lower, it means that these stocks are riskier because they pay less, so they don't provide a good hedge against aggregate risk. So these are riskier, and since this covariance is negative, negative times minus is a plus. This means that they require higher expected returns to compensate risk-averse investors. And so this is in general. So this is pretty much always true. And so in the context of policy uncertainty, there is the Pastore and Veronesi seminal papers in which they assume that stock dividends depend on the government policy, which is uncertain. And therefore, any policy change affects the future marginal utility, and therefore they affect the stochastic discount factor. And so in our context, our assumption is that increases in the trade policy uncertainty are perceived as bad states of the world by investors. So we believe that this is sort of reasonable and is consistent with empirical and theoretical evidence in finance and macro that uncertainty is bad for investors. But so this means what? Well, this means that stocks that are more exposed to trade policy uncertainty, so stocks with higher NTR gaps, they should have a larger, in absolute value, covariance with the component of the SDF associated with TPU. So we know, of course, that inside the SDF there are several risk factors, and we will control for them in the portfolio analysis. But the important thing is that the risk factor associated with TPU, if there exists, should imply higher, like stocks that have more exposed to that risk factor should have higher expected returns. Okay, so we will now provide you 3 pieces of evidence to support this hypothesis. Okay, so if everything is clear in sort of theory, because sometimes people get confused between effect of cash flows versus the SDF. That's why I thought of having 2 slides on this. Anyway, so how do we do the portfolio analysis? So we first rank the industries in our sample in 3 subgroups based on the NTR gap in 1990, so right before the uncertainty began. Then we construct value-weighted portfolios and compute monthly returns for each portfolio between the 1990 and 2001. And then we construct a TPU portfolio as a difference in returns between the high gap portfolio and the low gap portfolio. So why we do that? Well, because under the assumption that any unobserved risk factor is orthogonal to the NTR gap, so it's sort of randomly assigned between any of these 3 groups, taking the difference between the high versus low gap portfolio should average out these unobserved risk factors. Okay, then we estimate a regression of the returns on each of these 3 portfolios plus the TPU portfolio, so 4 portfolios, on a constant and on a vector containing the 5 FAM and French factors. So these FAM and French factors, I'll show you in the next slides. They are like the most important risk factors that have been shown by the literature to affect returns. And then what we're interested in is not really the beta, so the loading of the portfolio on the factors, but we are interested in actually in the constant of this, because the constant is essentially the excess return of portfolio P that is not explained by the loading of that portfolio on the 5 FAM and French factors. So if our hypothesis is correct, we should observe the alpha P to be monotonically increasing as we go from low to high gap portfolios, because the returns are, the unexplained part of the returns are higher for high gap portfolios. and it should be positive and significant for the TPU portfolio. Okay. Good. So these are the results. So you see here we have the 5 Fama-French factors. So market means the overall stock market. So this is essentially, so if you had a regression with only market, that would be the standard capital asset pricing model, where you only have one factor, the market. Instead, here we are adding the 4 Fama-French factors. So size, size, value, profitability, and investment. And if you want to talk about how these are measured, we can talk about it later. Okay, but then let's look at the alpha P, so the constant, the alpha of a portfolio. So you see here that it monotonically increases when we go from low to medium to high gap. And more importantly, is strongly significant and positive for the TPU portfolio. So if you annualize this, because it is monthly, you get that the TPU portfolio earn a risk-adjusted excess return of 6% per year. So that's a very large number. And this means that the trade policy uncertainty during the 90s was a systematic factor that could not be diversified away. Okay, so yeah, that's what. So we will. So that's essentially what this is saying. Now, here there are some robustness and extension that are important. In particular, very importantly, is this. So here we repeat the portfolio analysis, but only for the control groups. So here we only do it for the 80s, and here we only do it for the 2000s. So you see here that the alpha is not significant. Here it is slightly positive, but it's not significant. Here is even 0. So this means that TPU was not a systematic factor in the 80s and in the 2000s. Was only in the 90s.
Federico, it seems like
Yes.
you need more significant digits on your standard errors to be able to back up your statement.
Yes. Yes, you're right. Yeah, I don't know what. Yeah, we should have 3 digits. Yeah. Okay. Thanks. Yeah. I'll fix that. Thanks. Yeah. Okay. So this is, sort of a sanity check, because if we were to find a positive significant alpha here, that will be very bad, because it means that we see a TPU when there is no TPU. So it's it's very bad. And then another sort of sanity check, we call it a placebo test, is repeating the same portfolio exercise, but for foreign countries. So countries in which you shouldn't observe TPU, because there is just not this mechanism, right? And in fact, you see here that the alpha is never positive and significant for any of these 6 countries. Unfortunately, we only have 6 countries. So these are the countries for which we have good data. At most we see a star here, but is in the wrong sign. So, this is suggesting evidence that we really. So this effect is not really an industry level effect, but it was more like a US TPU effect. Now let me go back to the robustness. Okay, yeah. So let me see, what time is it? Okay, it's fine. So yeah, so here is an extension of the business portfolio. So here, the idea is the following. So we perform a double sorting. So essentially, we want to look at which are the industries that were earning most of the risk premium, or in other words, which were the industries that were more exposed to trade policy uncertainty. And so, there is nothing really that can guide us, on which variables to use. So we thought of using trade policy variables. So we start with NTR rates. So here we are double sorting industries. So we first So we first sort them in low versus high gap portfolios, and within each portfolio, we sort them in low versus high NTR rates. So a low NTR rates means that industry had lower tariff rates, right? So it means that industry, at least from that perspective, was less protected from globalization relative to other industries. Okay, so when you do that, and now I'm showing the TPU portfolio for low NTR and for high NTR, you see that the TPU portfolio is positive and significant only in industries that have a low NTR rate. So it means that these are industries that have they were essentially more exposed to globalization because they were less protected by tariff. And a very similar result occurs here when we double sort on shipping costs. So the shipping costs are an industry level measure of a trade barrier used, in the famous Barrault and Sauvignon Journal of Finance paper. And essentially here we find the same. So we find that industries with low shipping costs, so industries that were more vulnerable to globalization, they were the ones earning the risk premium. Okay, so this is sort of, like we know that it's just suggested evidence, but we think that this is sort of reasonable. This is saying that industries that are in general more vulnerable to globalization, they are also more vulnerable to uncertainty about trade policy and therefore uncertainty about globalization. Okay. Okay, in the interest of time, let me skip the other robustness, but I can go back in case you have questions. So this was the first piece of evidence, so the portfolio analysis. The second one is the discount rate effect. So in any asset pricing model, the stock price of firm I at time t equals, as Marco was saying before, the dividend, so the future dividend divided by the a weighted average of all future discount rates minus a weighted average of future growth rates. Okay, if we believe the results that I showed you before, then we should expect the TPU to be embedded inside the discount rate. So essentially, the discount rate R embeds firm I loadings on all the risk factors that are priced. So inside the R here, we should see, the loading of firm I on the market, on the 5 FAM and French factors, and on our TPU factor. So this means what? This means that whenever there is a sudden jump in trade policy uncertainty, this should increase the discount rate, so increase R, and decrease the stock price. So essentially, this means what? That the day the uncertainty on China's NTR status began, we should observe a sudden decrease in stock prices for more exposed industries. So we do that. So essentially, we go back on time and we try to understand when this essentially new state of the world began. And we found out that the first resolution to revoke China NTR status was essentially made public on July 23rd. And so was made public that the House was considering revoking China's NTR status. So this is sort of the day in which the uncertainty began. So in this graph, we are plotting the value of $1 invested on May 24, 1990, which is the day when this resolution was proposed, was submitted to the Committee of Ways and Means. Over time, so the 18th of July was the day when this was ordered to be reported to the committee, and July 23rd is the day in which it was actually reported. So the day in which it was actually made public. And October 18 is the day when the resolution was actually approved. So you can see here.
Federico, wouldn't
Yes.
the day of the massacre be important to include as well? Because that was really the news that started everything.
Do you mean the Tiananmen Square?
Yeah, right. Isn't that the kind of causal thing?
Yeah, okay.
Congress to think about.
That's a very good point. Okay, so actually, so I don't remember the details now, but the details are in the paper. So actually, when there was the Tiananmen Square incident, there was like, so there is, we provide some evidence that it wasn't really in the public debate to start this voting. So essentially, there were discussed some sort of punishment policies from China, but was never discussed to revoke the NTR status. So the first day in which the NTR status, so a discussion like the possibility that the NTR status could have been revoked actually started on July 23rd. And in fact, we looked at the same graph, but when Tiananmen happened, and nothing really happens. So we should probably show the graph to show that the uncertainty, seems to really begin at this stage. You see what I'm saying? Like, so when there was the incident, it wasn't really clear that the NTR status could have been revoked because nobody was talking about it.
Right.
Okay. Yeah. So if we believe that this, clearly is hard to measure, of course, but if we believe in this day, this is pretty clear, that high gap stock prices went down relative to low gap stock prices. So this is suggestive evidence that the discount rate went up. Now, of course, as Marco was saying before, of course, P went down, but P could have gone down also because expected cash flows went down, or because the growth rate of dividends went down. So we try to falsify both explanations. So first, we look at the dividends paid in 1991, so the 1 year after, and they actually increased relatively more for high gap firms. So that cannot really explain the drop in stock prices. And then we also look at the dividend growth rate throughout the entire uncertainty period, so G, and that wasn't statistically different between high gap versus low gap firms. So, it doesn't seem, so neither D, T+1 nor G seem to have an effect on P. But, and as Marco was saying, this is a very challenging thing to show in finance. But yeah, so we do our best in
Federico,
this case. Yes.
So one thing I was just wondering about is, in that entire period, imports of those goods from China rise faster than the high gap goods, the imports rise faster than the low gap goods. In some sense, that's kind of a reflection of past liberalizations. So that's a little bit hard to square with the fact that there's no dividend kind of growth gap. Unless the extent that these firms are paying out dividends by not investing. Have you looked at those two, how sales are evolving and how investment are evolving?
I see. Okay, that's a very good suggestion. Yeah, we have. So we only look at actual dividends, but that's a good point. We could look at sales or investment, right?
Yeah, I mean, it's like Kodak started investing in all kinds of crazy things at the very end, but that was kind of, they should have been giving it back to their investors. Okay,
that makes a lot of sense. Thanks, George. Yeah, I just wrote it down. Okay, good.
Federico, sorry. So I'm trying to reconcile some results because the expectation clearly changed, but somehow wasn't realized. So how, and it seems like the expectation, instead of, there's a prospect of higher import competition, or there's a prospect of lower import competition.
Yes.
And so there is a positive scenario for these firms potentially.
Exactly. So
why wouldn't the level of
Yeah, that's exactly, that's
The
that's a good
level
point.
of
So
returns go up just
exactly.
from the level of the expectation.
So how do you
Cash flow
disentangle?
discount.
Yeah. So how do you, yes, so how do you disentangle the higher expected dividends versus the higher discount rate, right? You're right, and but like it's hard to to say. Like we did the best we can do. So look at dividends throughout the 90s, and they don't seem to go down for high gap firms. And in fact, here it's probably consistent with what you're saying, right? So that there is uncertainty, so high gap firms are more protected from China, and so dividends went up in 1991. But then I guess prices went down because the discount rate effect was stronger than the cash flow effect. You see, so this is sort of in favor.
Theoretical argument, but the first order effect, I would think, was the expectation itself.
Yeah, I totally agree. Yeah. So yeah.
It's not
All of this is assuming rational expectation, perfect foresight. Yeah, point taken. I totally agree. But again, yeah, like it's hard to disentangle between expectations and actual dividends. But you're right. Yeah, we are looking at the ex post dividends. Yeah, and they went up in 1991. But yeah, we don't know the expectation for sure. You're right. Yes. Okay, yeah, the last piece of evidence, I have 3 minutes, is about relative volatility. So yeah, regardless of whether the policy change was good or bad, there are many papers that show that firms more exposed to a policy change should have larger responses in absolute terms than less exposed firms. So like for example, investors, they trade more, and so there are more trading volumes, and so there are more larger responses. So we test this hypothesis by looking at the realized volatility as so essentially the sum of squared daily returns for firm I in day T, and we regress this on the NTR gap in 1990, so a measure of the exposure to TPU, and an interaction of the NTR gap, so the exposure with a dummy for a policy event. So essentially, this is an event study. So we look at a window of 3 days before and 3 days after relevant policy events that happen throughout this period. So we look at congressional voting days, the date the day Clinton granted China a permanent NTR, the day China joined the WTO, and the day the PNTR went actually into effect. Okay, so what we find in the first column is first, on average, during these days, return the realized volatility was not significantly higher for all firms. First fact. Second fact, throughout the entire period, industries with the higher gap had the higher realized volatility. Again, this is throughout the entire period. But then third fact is that they had the higher volatility, even, they had the even higher volatility around these policy days. And so this is consistent with the Pastore and Veronesi model, that says that if you're more exposed to trade policy uncertainty, you should have a higher realized volatility. So this is a suggestive evidence that we are measuring something meaningful with this NTR gap. So whenever there is a policy event related to TPU, these firms more exposed to TPU, they actually have higher volatility. Okay, so in the last, if you just give me 1 minute, I could quickly show you a couple of results. So the first one is that, like if capital markets are efficient, stock prices adjust quickly after news announcement, and so they incorporate any changes in expected future cash flow. And in fact, the Greenland paper has recently shown that firms, the short-run response of firms to the PNTR is a good predictor of future cash flows. Okay, so this is a concern because our portfolio analysis may be contaminated by this effect. So what we do is we exclude the window of 3 days before and after each policy-related event, and we include the same policy events that I showed you before. So this is the result. You can see that the alpha of the TPO portfolio doesn't change. So essentially, apparently, the cash flow effect was not driving our alpha in the baseline. Okay. Second, well, let me skip this. This is totally important. The last thing that I think is very important is a protection from China. So as we discussed, high gap industries were receiving an implicit protection from China thanks to the uncertainty generated by this scheme, right? And so they could have enjoyed higher expected cash flow, as Cecilia was saying, and therefore higher returns. So the way we try to, falsify essentially, or to control for this, is by double sorting portfolios on the NTR gap in 1990 and on the Chinese import penetration at the industry year level. So we look at industry year level import shares from China. We look at import shares average throughout the period, beginning, the end. So we kind of do a little bit of robustness. So if this alternative hypothesis was true, we should see that the risk premium was concentrated in industries that were more protected from China, right? So industries that had a lower import share from China. When I say import share, I mean not inputs import. I mean imports in general, so competition from China. So what this graph shows is actually the opposite, because if you look at the last two columns, so the TPO portfolio, you see that actually the entire risk premium was earned by industries that had a high imports share from China, not the industries that were protected by China by having a low import share. More in general, if you forget about the NTR gap, if you only look at industries with a low import share from China, there is no risk premium here. So it's not true that industries that are more, they have less imports from China, they have higher returns. Okay, so this is not true, at least in the long run. Okay, so let me conclude. We have shown you a large risk premium for exposure to trade policy uncertainty, which amounts to a 6% per year. And we also shown you a large discount rate effect at the start of the uncertainty and a higher realized volatility throughout the period and around policy events. And we rule out alternative channels such as the cash flow effect and the implicit protection from Chinese competition. So yeah, if you have further questions, I'm here to discuss. And
I'm back, Federico.
Yeah, Marco is back. That's good. Thank God he's back.
Okay, great. So everybody can feel free to either just unmute and jump in, or you can use the raise your hand functionality if not. Otherwise, we'll just leave the stream open and people can start asking questions.
Federico, sorry, this is Daniel Xu. Sorry, I missed the first 10-15 minutes of the talk. So maybe I'm asking a question that it shouldn't be a question. I've been just wondering. Now we talk about import competition, but there are a bunch of downstream industry that use these Chinese imports mostly as imports. So maybe you already touched upon that. So again, just apologies. I've been wondering how should I think about those? Because the question is how broad your industry is here. Should we think about purely just import competition, or there could be also a downstream effect?
Yeah, that's a very good point. Yes. So in a previous version of the paper, we had we actually explored this. So essentially, we will doing a specification similar to Acemoglu, Otordone, Hanson Price, where they look at downstream and upstream linkages, and we actually see that. So not only this the returns are higher for high gap firms when these firms compete with China. So they are in the same industry, but also when they source inputs from China. So also, sourcing inputs from China that are more uncertain. So inputs that are, that have on average higher NTR gaps, that are also a source of uncertainty that seems to be priced by investors. That's the first thing. Another thing that we show is the following. So let me show you this, and it's actually something that I haven't shown. So what we do here is we take the portfolios and we double sort them. So we sort them first based on the NTR gap. So we take low gap versus high gap, and then we sort them on the inputs or the share of inputs from China. Okay, so this low means that this is an industry with inputs share from China that's less than the median, and high means that it's higher. So you see here that industries that were importing a lot of inputs from China seems to be the one that are more exposed to trade policy uncertainty, in the sense that they have a significant alpha. Okay, so it seems that importing inputs from China, so it seems also to be an important measure of how investors perceive the exposure of an industry to trade policy uncertainty. So essentially the riskiness of an industry.
Okay, got it. Thanks.
Okay.
I have a question.
Yes.
Yeah. So this is Robert Deacle. I like this. It's a nice paper, but I missed the first 10 minutes as well. But in the, there's a paper by Bloom and a set of papers by Bloom and Davis, right? And they relate these uncertainty shocks calculated from. Is that the origin of your? Have you?
Okay. Yeah. So.
Yeah. Oh, do you want to get this one or?
Yeah, and in fact, so Marco is one of the co-authors for the other paper. But let me first say one thing, and then Marco can contribute. So one thing that we think is useful here is that the original QJE paper, so the Bloom, Baker, and Davis, they have like an aggregate measure of uncertainty, which is time varying, right? But instead, the benefit of using this NTR gap is that they vary at the industry levels, and actually potentially they could vary at the product level. We aggregate them up, but potentially you could run these regressions at the product level. So we don't have the same time variation, but we have the cross-sectional variation. So that's essentially.
Yeah. So you guys went in and looked at the newspaper reports. Is that what you ended up?
That's the other one. Marco, maybe you want to say something?
Yeah. So what the Baker, Bloom, and Davis paper is doing, and just I'm not actually on that paper, Federico. I'm looking at it with a different paper.
Okay.
On what they're doing is they're taking the newspapers and they're counting up words in 3 categories. Words related to the economy, words related to uncertainty, and words related to policy. And they're seeing, how that varies over time in aggregate. And they even constructed a specific version of that index for trade policy, right? And you actually see that that index spikes in the 90s because of the whole NAFTA debate that was going on. So what you might be asking is, do you believe that our variation in trade policy uncertainty is independent of the variation you get using the Baker, Bloom, and Davis index, right? So we tried that. So we did it 2 different ways. Given that it doesn't vary at the firm level, we took kind of like a Fama-Macbeth approach. And what I mean is, at the firm level, we regress each firm's returns on changes in the index over the past year, 5-year, whatever. Then we sorted firms into portfolios based on the betas on the EPU index. And we found that there was actually nothing there. So between 1990 and 2001, whether you sort firms on the past 1-year exposure or the beta on the trade specific factor changes or the whole EPU specific factor changes, there wasn't much there. Now that's another paper we cited, Brogard and Drexel. They do an EPU specific beta sorting for a larger sample, and they do find something there. So I think that there might be a risk premium for exposure to that TPU uncertainty, for the aggregate EPU uncertainty. But I think that at least given that we find such a large significant alpha, even given the small number of observations, and we don't find it when we use the betas on the trade policy uncertainty index, I think we're getting independent variation.
Thank you. Yeah.
Very nice. Other questions?
Federico?
Yes.
Hi. I was just wondering if you had a sense of what's happening to concentration in the high gap versus low gap industries in this time period. Because I know that the high gap industries are, like, we kind of know what industries those are, like very specific industries, steel, textiles.
Yes.
So I was wondering to what degree those are kind of driving everything.
Yeah, I remember Mark Rat. We looked at that at some point, and we also cite an existing paper, right?
Yeah. So I can't tell you exactly about the dynamics because we have a bit of a biased sample, right? Because we're only looking at publicly listed firms. And as we know, there's been, I think the Simca Barca's paper, we know that the publicly measured firms is a lousy measure of concentration. But what we did do is we went to the census data and we got the concentration measure at the NAICS 6 level. And we interacted that with our measure of policy uncertainty to see whether or not the effect the effect that we find was concentrated or high or low competition industries, right? And I'm not recalling exactly, but I know we were doing something like that. Maybe it's worth looking into that again. We did it a while ago, but I think it's a good point.
Yeah.
Okay. Yeah, I think more generally it'd be interesting just to see what industries are driving this, because it's like
so is your prior that industries more concentrated should have a higher should be more protected. I see. Yes. Okay.
That are becoming more concentrated.
Yeah, exactly. Yeah, because our thought was that industries more concentrated, they are more protected from competition in general. So they should be less exposed to trade policy uncertainty. That's what we were arguing, thinking. Yeah, but then the results they seem to confirm that industries more concentrated had smaller risk premium because they were more implicitly protected by market power.
Yeah, I just pulled up the table here in our old version of the draft. Yeah, when you interact the NTR gap with the period of interest for either using the HHI of the top 50 or the top 8 concentration, it's negative and significant. So highly concentrated industry had a less effect from the trade policy uncertainty.
Oh, thanks. That's a good point. Yeah.
Sorry, can you guys hear me?
Yes, go ahead.
Okay, sorry. Yeah, I was wondering, like, you use this as a risk premium, right? You say, oh, we capture the risk premium. And then you have this slide about like the covariance with the stochastic discount factor.
Yes.
And so I was kind of wondering, what do you have in mind? What do you think is the fundamental shock, this trade policy uncertainty variable that does affect the SDFs? Like this has to affect the aggregate economy, right, to be in prices. So I was sort of like wondering, what do you think it is?
Well, so we are thinking about a model like the Pastore and Veronesi model, right? So where the government policy actions affect the dividends of firms, and therefore any uncertainty about the action of the government, they affect the stochastic discount factor.
Right, but their thing is aggregate, right? So their thing is like the government affect the aggregate uncertainty of the whole economy. And
exactly.
It's really about sort of like thinking about the cross section. Some are going to be affected, some not. And so I'm just wondering, like, is there an interpretation of your paper saying like, oh, this is like the aggregate effect of this like decisions of the NTR gap to,
Well, that's a good point. Well, so that like the decision to either revoke the NTR status or not was aggregate. So basically, either the Congress revokes the NTR status for all industries or not. So essentially, the probability of a renewal is the same across industries, but then sort of the exposure to it, so how much that matters to you, is captured by how much the tariff would increase if that state of the world would happen.
Right. So having to interpret basically uncertainty on the NTR gap is something that does affect like the aggregate GDP in a way, or I mean that's what I'm trying to understand. Like this is like this is a big claim, right? I mean, saying like, oh, this like small thing in the economy, it seems to affect how I'm gonna price all assets. That's
I see.
Yeah, I think so. I think that maybe this is a different way of saying what you're saying, is that there's some latent trade policy uncertainty factor, let's suppose it exists, that we cannot observe as econometricians. In fact, all we can observe is an indirect measure of the loading on this factor, which we proxy as the NTR gaps, right? That should give us some kind of ordinal ranking of exposure, but it still doesn't tell us actually, first of all, what the factor is and how exposed to it you are, right? And so we're basically trying to, by doing the long short portfolio, back it out. But your point is well taken. I mean, unless it's affecting aggregate consumption or you think it's feeding back. But to that, I would say, if you think about what happened after the uncertainty was resolved, like in the post period, we know that there were definitely winners and losers. That's the point of a lot of those papers that show that once China joined the WTO, some people's consumption really dropped a lot. And some people's consumption.
It's not good for you because this goes in the opposite direction. I wouldn't really go there, but yeah. Okay, thanks.
Can I follow up on that just a little bit? Because I had something that was a related thought, which was,
sure.
You know, in some sense, I think what we're thinking about is that these industries are going to do particularly bad in the 2001 recession, and maybe particularly bad in the Great Recession. You know, that when you were talking about it being the stochastic discount factor, that's sort of what I had in mind. And so maybe like when you were looking at these dividend flows, like you just didn't look far enough out, right? And it's not really, it's really just about somehow like the protection these guys were getting was going to kind of go away in particularly bad periods. And you care more about that.
But that also is bad for us for the same reason I think that Eric said, right?
Yeah. Okay.
Yeah. Well, I cannot speak to dividends results, but at least in the baseline, the results hold if we exclude the 2001, like the year of the recession, 2001. So the results are not driven by the drop in stock returns because of the recession.
No, but I guess I didn't follow. I mean, we know that these industries are all ones that kind of did worse in 2001 and 2008, right? I mean, they had to have done worse. That's the whole picture that Pearson, Schott, and those guys are kind of showing us. So why doesn't that then, if all of a sudden these industries become like more cyclical in some sense, why doesn't that explain your results?
Well, because you can say, well.
I mean, I'm giving I need like.
You could argue that these high gap industries, they were protected implicitly in the 90s, right? And that's why they went much worse after, right?
Yeah.
And that's why we try to check for that with the double sorting portfolios. So we try to control for that by looking at the import share from China. But I take your point, like the general vulnerability of an industry. Well, maybe like one way to do it, and we thought about it, but we haven't done it, is to look at which are the industries or firms that perform well even after 2001. So like think about Pearson Schott, right? So they say that high gap industries, they had lower employment and also lower investment, right? Then if you take the firms that performed well after 2001, so industry firms that did not really suffer in China in terms of employment and investment, and repeat the portfolio analysis only for these firms, then maybe you could isolate away, like take away the effect, the post-period effect, and only So what I'm saying that if we repeat the portfolio analysis only for these firms and find similar results, it means that even for the best firms, the firms that were able to compete with China, we still see a risk premium. And so that's kind of suggesting that it's uncertain, but we haven't done it. we were just talking about with Marco yesterday, actually.
And I would say also, I mean, in a way, one of your things is saying that it's really just it's not really a risk premium. It's for some aggregate shock in the SDF. What it really is that we knew at some point these firms were going to get hit by a shock. We didn't know when it was, but it made these firms riskier. So the discount rate had to increase for these firms. And then that shock came, and it was 2001 when these firms got killed. And so then it's not about uncertainty per se. It's just that these firms were going to be more ex post exposed to the resolution of uncertainty that would bring in a flood of competition, right? That would be a different interpretation of our paper's results, I think.
That's the first,
That shouldn't be in the price. Sorry, George.
no, I was saying that then that shows up in the G term, right? That when you did your discount, your,
The R term, yeah, the R.
well, it's not in the R term because that was all about like when you your dividends are kind of falling. It was just an expected, liberalization. So it shows in like the growth rate of the dividends.
Yeah, okay. Yeah, yes, sure.
Sorry, Eric, I didn't mean to interrupt you.
No, I was actually gonna say the same thing. I mean, if it's not a risk premium, then it's not in prices, or at least it's not in the return. You have to pick. You have to stick to your story, I think. Like.
No, I know. I agree that that's outside the story. I was saying that might be another interpretation of the results, ignoring that story. Yes, I agree.
So there is another thing I wanted to ask when you're talking about this is that, so I think I didn't grasp the diff-in-diff, and I'm not sure this is what you did, but are you actually comparing two firms that have the same kind of like level of protection, but one that has a high NTR gap and another one that has a low?
Yes, because, yeah, exactly, because we control for the NTR rate. Yeah, so controlling for the level, you are looking at the gap, yes.
And so you don't observe anything different, or you haven't looked at investments along the way, because something that we know is predicted by uncertainty is like investments, right? Firms or FDI or whatever, like firms cut back on investments when things get choppy.
Yeah. We haven't looked at investment. Yeah, we haven't looked.
Those are like real effects that might, as George said, like affect G, I guess. Like.
Yeah, there is a paper by Pearson Schott published on JIE that look at investment after. Yeah. But yeah.
We did look at investment at one point. We will double check it. Yeah.
Yeah, we'll double check it. Yeah.
Let me stop the recording.